Over the last few years, the stock market has been acting like nothing can ever go wrong. And as that continues to happen, it gets validated even more. But that's exactly when the biggest mistakes happen. Everyone's buying AI, everyone's buying crypto, whatever is shooting straight up, and they actually think that that's investing. But I'm telling you something that people on YouTube will never say out loud. The next 10 to 15 years will not nearly be as good as the last 10 to 15 years. And if you don't understand what's happening right now, you're going to make a lot of emotional investing mistakes. And it's not your fault. It's the way it happens. And I have to say this. Usually people use these titles as clickbait, and usually I'm opposed to them. But in this market, with how valuations keep on getting even more stretched and people's speculative behavior keeps on being exaggerated, I truly believe that we will be heading toward an opportunity in the stock market that most of you have never seen in your lifetime. I just don't know when. In fact, it might be the single biggest opportunity you and I will ever see. So let's talk about the truth that nobody else wants to say out loud, and more importantly, how to prepare for the moment that could change your financial future forever. Let me start by saying this very clearly. This video is about investing, not guessing, not speculation. Trying to time the market is pure speculation. Preparing for it is investing. So why do I think that the market right now could be set up for a major pullback? Well, for one thing, what's different right now is the mindset investors have been trained into over the last 10 or 15 years. The markets have rewarded one behavior, always buying, regardless of price versus value. And trust the prices will recover very quickly when there is a pullback. The buy the dip mentality, forget about that. The buy the crash mentality has been absolutely flawless for the last 15 years. People like Michael Saylor, Cathie Wood, and Tom Lee are out there saying things like they're experts just because the market's going up. But I want to remind you guys what Warren Buffett says. He always says, we don't know who's naked until the tide recedes. What that means is when a rising tide is raising every single ship out there, you don't know who's naked underneath the water. That just tells me that things aren't going to be the same for the next 10 or 15 years like they have been for the last 10 or 15. And I cannot stop repeating that until I'm blue in the face. These kind of market conditions create overconfidence, major recency bias, and the belief that valuation doesn't matter. So in this video, we're going to slow everything down. We're going to look at what's actually happening under the surface of this market and how disciplined investors like you can think differently when prices and reality start to disconnect. You've seen the rising volatility across all assets as of late, but our goal here is not to scare you. It's to prepare you with logic, process, and patience. We're preparing for the kind of market that separates investors from speculators. Now, like I said, this title, at first, I was like, I actually believe in this title very much. A lot of times we'll put titles out there to get you to click to teach another lesson. But in this one, I've said this. I don't know when it's going to happen, but I believe after the next bear market is over, it'll be a massive opportunity for people who are able to remove the noise and the fear from it. If you zoom out, indexes are still at or near all-time highs. But when you zoom in, the story starts to change just a little bit. We're seeing some of the same companies that led this market higher begin to crack. Large cap tech stocks are beating expectations, but are falling after earnings. They're tumbling in a lot of regards. A lot of great companies have seen a lot of sideways movements for the last 6 to 12 months. So crazy, Intel is up 160% in the last year versus Nvidia, which is up only like 50%. AI CapEx went from the word that sent stocks soaring to the one that might be burying them. Guidance is being questioned, and even strong earnings aren't being rewarded the way they were a year ago. I would argue that these stocks are falling because people are realizing that in a capital expenditure cycle, the investment takes longer than expected to actually show real results. I would say that based on what we saw over recent weeks, stocks are not reacting positively what's actually good news. Valuations are getting challenged. Guys, think about this. Amazon grew revenue 14% and the stock still fell over 10%. Microsoft, which has risen on earnings repeatedly for years, showed incredible earnings and fell over 10%. Even Google, one of the hottest stocks of the past year, tumbled precipitously down. I want you to recognize something important here. Money is rotating from these tech names, which have led the rally, into safer names. People get scared by the smallest bit of volatility, when the market's falling, names like Coca-Cola, Procter & Gamble, or Costco are up day after day. It's a flight to safety. Now, what's even more concerning is that investors who ignored valuation to buy the best tech stocks are ignoring valuation to buy safety. So why don't we talk about valuation just a little bit more? One of the most dangerous things in investing is when something doesn't matter for a long time, and people assume that it'll never matter again. That's what I believe has happened with valuation. For years, investors have been rewarded for ignoring it. Stocks traded it at extreme multiples, prices ran far ahead of fundamentals, and nothing seemed to break. You were only rewarded for doing that. So naturally, people concluded that valuation was outdated, old school, or irrelevant in a world of AI, zero interest rate policy, and infinite growth stories. But guys, valuation never disappears. It just waits. And when it finally matters again, it doesn't do so gently. Valuation is not a timing tool. It's a risk gauge. It doesn't tell you when prices will fall, but it tells you how much damage is possible when expectations reset. And when markets are priced for perfection, even great companies can see their stock prices drop sharply. Not because the business has failed or is getting worse, but because the price left no room for disappointment. That's the environment that we're in right now. The longer valuation is ignored, the more powerful the eventual pullback becomes. And when it arrives, it doesn't feel like a math problem. It feels like a shock. Guys, I want to be very clear about something, and I need you to hear me with a calm mind. We will have a bad bear market. This isn't fear-mongering. This isn't doom and gloom. This is history. This is math. This is valuation. Right now, we are living in a market where everything looks perfect on the surface because the results have been perfect. Things are not nearly as strong as people think, especially for large cap businesses. And trust me, I own a lot of large cap companies. I'm not sitting here pretending that they're immune. They're not. I expect my stocks to fall very hard when a big bear market comes. But here's the key difference. I buy them at the right price with discipline, and I wait. And if the price gets better for me, I buy more. Because every time in history, not some of the time, not most of the time, every time, when valuations reach extreme levels, we see lower future returns on stocks for a period of time. And today's valuations, they make the dot-com bubble look reasonable. Think about it like this. In 1999, right before the crash of 2000, the stock market to GDP ratio was 60 to 70% above historical average. Today, we're almost 130% above normal, nearly double the insanity of 1999. So what does that tell us? It tells us exactly what history already shows. Extreme valuations always come down. Always. Not because the world ends, not because companies disappear, but because price eventually has to reconnect with value. Now listen to me carefully. This is not about predicting when that will happen. Nobody in this world, not Buffett, not Fed, not me, nobody, can tell you the exact day, month, or year that the bear market starts. That's not the point. The point is understanding that it is inevitable, and the type of behavior you need to have when it happens is very, very important. If you're prepared, if you stay disciplined, if you buy great companies at great prices and realize you're not going to buy at the bottom, then the next big bear market becomes the single greatest wealth building opportunity of your lifetime. Morgan Housel has said it many times, and I love quoting it. Every past crash looks like an opportunity. Every future one looks like a risk. We want you to sit there and look at the future ones and say, that will be my opportunity as well. That opportunity is only life-changing for the people who will stay calm, stay rational, and stay disciplined. And they need to understand what price versus value actually means. And guys, I truly believe that the next bear market will offer opportunities that most of you have never seen in your entire life and may never see again. Whenever people hear that a bear market's coming, their brain immediately jumps to the wrong conclusion. So you're saying sell everything and sit in cash? Not at all. That kind of thinking is just the opposite extreme, and it's just as dangerous. Selling everything because you're afraid of correction usually leads to one thing: missing the recovery. Real investing is not about all in or all out decisions. It's about positioning intelligently. Now, I'm hoping some people watching this are saying, well, Paul, you have a lot of cash. I do. But only 30% of my net worth can even be invested in the stocks. 70% is in businesses and real estate that grow at very high returns. So my position in life And my ability to sit there and make money in other areas is the reason why I'm okay saying I can sit back and wait a little bit. But that's not everybody's position. You've got to remember that. Most people need to continue investing, continue dollar cost averaging, and being patient. You also need to do this while being selective about the prices you're willing to pay for individual stocks. The mistake most people make is confusing caution with paralysis. Discipline doesn't mean hiding from the market. It means staying engaged while refusing to chase overpriced assets just because everyone else is doing it. And that distinction matters more now than it has in years. Let me go back to what's going on in the market currently for a minute. The tech-heavy NASDAQ is where expectations are the highest. It's where growth assumptions are the most aggressive. It's what leads the market up. And as we've seen historically, it's what leads the market down. And I don't think that's going to be any different this time around. Now, that doesn't mean these companies are bad businesses. Quite the contrary. Many of them are quite incredible. Actually, I'd argue that the best companies in the world are at the top of the NASDAQ. But because these are the favorite names in the way up, even a small disappointment, whether it's slower growth, higher cost, delayed AI, can cause a sharp reset. We have seen this countless times before, and it will happen again. In the early 2000s, the NASDAQ didn't fall because technology was useless. It fell because expectations were unrealistic. And then when those expectations came back to earth, prices followed violently. The NASDAQ fell over 80% from the peak of 2000 to the bottom. We've already seen this start over the past 2 weeks. Tech has fallen way harder than the rest of the market. If you look at the 2022 bear market, tech fell way harder than the S&P 500. Now, the S&P is still close to all-time highs, but a company like Microsoft is down over 20% from its high last year. Palantir is down in the last 3 months from a high of 207 to 135 as of the recording of this video in just a matter of 2 or 3 months. And some of the most painful losses in market history didn't come from bad companies. They came from great companies bought at unreasonable prices. Think back to the early 2000s. Walmart, Amazon, Microsoft. All incredible businesses, but they all saw 50% plus declines. Guys, Amazon fell 96% from its peak in 2000 to the bottom. I expect the NASDAQ and tech more broadly to fall way harder than the S&P when this cycle turns. And ironically, that's exactly what's going to create the best long-term opportunities for disciplined investors who are prepared to act. I am beyond excited to own some of these names. I will be buying QQQ, which is the NASDAQ 100 ETF, month in and month out in the future when valuations are more favorable. But guess what? I'm going to start dollar cost averaging when the valuations are still above historical values. Guys, this is the main reason why I teach on YouTube, because I sat there and saw these videos and these people commenting, and it was basically people who bought a company, the stock went up, so they thought they were geniuses. Sorry, that's not the way it works in the long run. In the short run, obviously, it's the way it works, and that's the way it's perceived to be, but it's not reality. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, "Paul, can you give us that software?" And I said, "Well, I can't because it's mine right now, but I can create it." And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. Now, let's get into the part everybody actually cares about. What should you do right now? Because hearing that the market's overvalued, hearing that speculation is everywhere, hearing that a big bear market will come, that doesn't help you. It actually puts fear in you unless you know the right actions to take. So here's exactly what I think investors should do. And this is the same stuff I actually follow myself. First thing, don't stop investing. Dollar cost averaging stays. Guys, I dollar cost average every single month into SCHD. I don't care how hard the market is. I don't care how scary things feel. On the first of every month, I email my brokerage and say, guys, buy X amount of dollars of SCHD. Thank you very much. In fact, I also sell cash secured puts on SCHD for the following month. I don't care how scary things feel. You invest consistently. It's about putting in those habits. That's why I do it. Now, what about individual stocks? Guys, you got to be cautious with individual stocks. If something is purely speculative, things like crypto, meme stocks, hype names that only go up because people scream about them on TikTok and YouTube, you don't need that in your life. Those are the things that fall the hardest when the cycle turns and everyone thinks they're going to be the first person out of the theater after somebody yells fire. It's not going to happen. Another idea? Slowly, quietly build extra cash. Not because you're timing anything, because you're going to be investing while stocks are overvalued. And when stocks are undervalued, it'll be your time to maybe deploy a little extra cash if you can. Now, the part that matters most is focus on quality, strong, durable businesses with real cash flow that are selling for reasonable prices. And please, don't chase a stock because of the recent price movement. That's how people get destroyed. The question is never, is it going up? The question is, what's this business worth? What am I paying for it? If you can pay a price for it that's lower than its value, you're probably going to do well if you do it across several companies. Guys, this is where people often misunderstand value investing, so I want to slow this down for just a second. Back in 1987, Warren Buffett began buying Coca-Cola at 30 times earnings. That's a 30 PE. By most standards, that's expensive, especially for a beverage company. And yet, that investment has turned into one of the greatest compounders of all time. Why? Because valuation isn't about buying something cheap. It's about paying the right price for the right business. Coca-Cola had and still has characteristics that justify a premium, a massive premium, a globally dominant brand, predictable demand, massive distribution advantages, and pricing power that allowed it to generate growing cash flow decade after decade. Buffett wasn't ignoring valuation. He was contextualizing it. But here's the key lesson that most people miss. Buffett didn't say any company is worth 30 times earnings. He said this company, Coca-Cola, was, based on its growth potential, durability, and future cash flows. That distinction matters more today than ever. Because in markets like this, people don't just pay premiums for great businesses. They pay extreme prices for growth stories, assuming the future will play out exactly as they think. Coca-Cola worked because the business delivered. When expectations and fundamentals move together, valuation holds. When expectations outrun reality, valuations snap back eventually. And that's exactly the lens that we need to use when we look at modern day giants. When you're looking at businesses like Amazon, Meta, Google, or Microsoft, you have to be willing to pay a premium. High returns on capital, low debts, and they're ingrained in the lives of everyone. I look forward to tech falling heavier because these are businesses that are on the top of my list of 30 companies that I want to own forever. Now, guys, never copy my portfolio or Buffett or anybody. You have a different age, different income, different goals. Your net worth breakdowns are different than like what I said earlier. But I'm going to be transparent. Like I said, I do the dollar cost averaging at SCHD. And even at today's high valuations, it doesn't bother me because these companies are stable and less overhyped than tech names flying around. I also own 28 individual companies, and I'm going to continue buying them as I find stocks selling below their intrinsic value. The biggest mistake new investors make is trying to get rich fast. The biggest advantage new investors have is time. Decades of compounding, decades of small decisions that turn into huge results. If you stay disciplined, if you stay patient, and if you stay focused on value instead of hype, you're going to do incredibly well over the long run. Now, guys, as I've been investing for decades, I've realized this. The hardest part isn't the numbers. It's not the valuation of the stocks. It's managing yourself and your emotions when the price goes the opposite way. That is the hardest part. But guess what I do? I anchor myself in the 5 tenets of principle-driven investing that I created. First one, we are investors, not speculators. Second, every investment is the present value of all the future cash flow it's going to give me. Third, if I don't understand it, I don't buy it. Fourth, in the short run, stock market's a voting machine. In the long run, it's a weighing machine. And the fifth and most important one, a great story becomes a bad investment if you pay the wrong price. Now, guys, I put together something very simple that I use personally. It's a cheat sheet with those 5 tenets that I shared with you, and it keeps me grounded when markets get loud. I read this thing every single day. It sits by my computer. It sits here in the studio. If you want it, I'm giving it to you for free. Click the link in the description below. You'll have it easy access for you, and trust me, it'll help shape the way in which your emotions respond to market movement. Also, if you want to see exactly how I value a business step by step so you're prepared when opportunity shows up, click the video on your screen. Thank you for your time.